Yesterday, I was telling you about bail-ins. It's where big banks take your money out of your checking account in order to bail themselves out because the government isn't going to anymore. And I said, this is the law in Europe starting January 1st. Well, it turns out it's been a law in the United States since 2014. In the European Union, the way bail-ins work is that if you have over 100,000 euros deposited in the bank can simply go in and take your money and say, we're going to apply this to our debts. Here in the United States, if you deposit money with a bank, the bank actually technically owes you that money. You have given your money to the bank, and essentially they have given you an IOU, which is your bank statement. Now, if the bank becomes insolvent, that bank owes a whole bunch of people different people money. And with the big 5 or 6 banks, with the really large banks, they owe trillions of dollars. Trillion is 1,000 billion. Trillions of dollars. Or they could owe trillions of dollars on the derivatives that they're sitting on. And so if those go south, those people get paid back before you and I do. Quoting this former hedge fund manager, Shah Jalani, he says, your deposited cash is an unsecured debt obligation of your bank. It owes you that money back. If you bank with one of the country's biggest banks who collectively have trillions of dollars of derivatives they hold off balance sheet, meaning those debts aren't recorded on the bank's GAAP balance sheets, those debt bets have a superior legal standing to your deposits and get paid back before you get any of your cash. Big banks got that language inserted into the 2010 big Dodd-Frank law meant to rein in dangerous bank behavior. And then Ellen Brown writes, Dodd-Frank states in its preamble that it will protect the American taxpayer by ending bailouts. But it does this under Title II by imposing the losses of insolvent financial companies on their common and preferred stockholders, debt holders, and other unsecured creditors. That includes depositors, the largest class of unsecured creditor of any bank. So what they can do, apparently, if I'm reading this right, is that the bank can convert your deposit, which is now an IOU, into stock in the bank, basically. So instead of being a deposit holder, you become a stockholder. And then, when the stock of the bank crashes, you take the bath too, I guess.
Hello out there, this is James Anderson, and welcome to the 6th Precious Metals Market Update from SD Bullion. We'll get back to bank bail-in news and how it intertwines with this week's biggest financial news as well, after this brief Precious Metals Market Update. Given this week's newsworthy events, I think it's a friendly public service reminder that is merited for those listeners out there who are watching. Most people are too busy with their day-to-day lives to know about the current G20 bank bail-in law of our land. These supranational financial laws have been on the books for now roughly 5 years of time. Under them, mega bank derivative bet winners, also known as first-in-line secured creditors, they stand to first inherit the assets of any large potentially failed derivative betting mega bank. According to bank bail-in laws, to the winning derivative bet first go the spoils and leftovers. Those who had unsecured deposits with a potentially failed global systematically important bank, or G-SIB, well, good luck. Let's have a look at the FDIC's latest updates to garner a better understanding of what is happening there and whether or not your deposits would be insured if your mega bank failed. In the USA, like virtually all national bank deposit insurance schemes, we too are running a confidence game against potential future bank runs. Current FDIC bank deposit insurance promises up to $250,000 per depositor, per FDIC-insured bank, per ownership category. For viewer convenience, here is a basic category-by-category overview of FDIC deposit insurance coverage from their website. In terms of the FDIC's latest balance sheet through the middle of this year, 2019, they have just over $100 billion saved to insure about $7.5 trillion, leaving just over $5 trillion of U.S. domestic deposits, which are likely over the $250,000 threshold uninsured. It is unlikely that your local bank or savings thrift is the big national issue here. It's more about the derivative betting megabanks and the growing illusion of competition within our crony capitalistic banking system that deserves a further flush out here. Since just before the 42nd U.S. President Bill Clinton repealed the Glass-Steagall Act, the United States then had over 10,000 FDIC-insured deposit banks and financial institutions in the late 1990s. Today, that number has just halved to around 5,000 FDIC banks. U.S. Congress Committee on Financial Services noted in a memorandum late last month that from 2006 through the end of 2017, over 3,800 bank merger applications were submitted to the private Federal Reserve. Not even one of these, thousands of bank merger applications, was rejected by the Federal Reserve over an 11-year time frame, which included the global financial crisis that peaked with the failures of Bear Stearns and Lehman Brothers. Currently today, just 6 Wall Street megabanks, JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley. They collectively hold approximately 48% of U.S. bank assets and deposits. The other 5,000 plus smaller banks and thrifts, they make up the remaining 52%. If any one of these large derivative betting U.S.-based banks were to somehow fail, dubious at best to believe the FDIC could make most unsecured depositors whole. Onwards to some important news from this week. The power behind the 2014 G20 bank bail-in law, the Bank for International Settlements, or BIS, had an interesting take on what is driving the now over $5 trillion in notional short-term overnight repo loans that have collected in total from the New York Federal Reserve since September 16, 2019. This following clip is courtesy of Bloomberg.
The BIS today saying that the recent wobbles we've seen in the repo market are not a temporary hiccup. They point to a concentration issue. Essentially, there are 4 banks which are vital for the repo market, which again is really important. It provides short-term funding, really the liquidity that helps the market continue to go. But because there are only 4 banks, those banks have shifted more into treasuries from liquid assets. That means that their ability to provide short-term cash is really limited. And then at the same time, we have hedge funds who increasingly have been using the repo market for that short-term funding. So you really have a mismatch between supply and demand. They say that what happened in September with the Fed having to jump in, providing short-term liquidity, we need more than a temporary fix because this is a long-term structural problem. And I should say this report is very ominous in this month of December when we tend to see the most seasonal illiquidity. And if we get any of that this month, we could see a fire sale.
This week also making headlines was financial system plumbing expert Zoltan Pozsar of Credit Suisse stating that the Federal Reserve will likely have to begin official QE4 by the end of this month due to the foreign exchange swap market liquidity and G-SIB balance sheet constraints. Both this Credit Suisse and former BIS report that we mentioned were contributing to the overnight repo loan saga ongoing. They got so much financial attention that the Federal Reserve literally had to plant the question in their press conference this week.
The BIS concluded in September that the repo spike was not a one-off confluence of random events, but reflected structural and regulatory issues that could lead to a recurrence. I'd like to ask you if you agree with the BIS findings, and given that we're approaching year-end for the markets, will you be taking any extra steps to ensure that funding is available in the repo and FX swaps markets? There was a report yesterday from Credit Suisse suggesting there's a good chance that we will see disruptions. And one of the reasons they put for it is that the Fed is, at this point, buying only T-bills and the market wants to sell coupons. Do you have any plans to sell coupons?
So I'm going to take a little step back, and I will get to your specific questions on the year end and on T-bills.
For about 2 minutes here, Federal Reserve Chairman Jerome Powell reiterates the Fed's talking points that the ongoing repo loan saga is not going to affect the global macroeconomy. But when referencing the end to this year, note that he leaves the door wide open for further Federal Reserve balance sheet expansion and financial market interventions to come.
You asked about year end. Temporary upward pressures on short-term money market rates are not unusual around year end. And both our repo operations and Treasury bill purchases are intended to mitigate the risks that such pressures pose to our control of the federal funds rate. We think that the pressures appear manageable, and we stand ready to adjust the details of our operations as necessary to keep the federal funds rate in the target range. Our strategy has been essentially the key to our strategy is to supply reserves in the near term through both overnight and term repo. And at the same time, we're raising the underlying level of reserves through bill purchases. I'll take that now. We've said bill purchases. We've also said that we were willing to adapt our strategy. We're not at this place, but if it does become appropriate for us to purchase other short-term coupon securities, then we would be prepared to do that if the need arises. So, but we're not in that place. It very much looks like the bill, those bill purchases are going well, just according to expectations. I mean, the other thing I'll say is that we're in, very regular contact with market participants all the time. We'll be continuing that, and we're prepared to adjust our tactics. We're focused on year end as well, and prepared to adjust our operations as appropriate.
What the Federal Reserve has in mind for the end of the year is not yet known. Oh, wait a second. Right before finishing this video, the New York Fed, published a partial unsolved mystery update to their end of 2019 plans.
Update.
It appears instead of QE4, the Federal Reserve is going to flood the overnight repo loan market with more liquidity than ever before, with promises of over $500 billion in swinging loans to come through middle January 2020. Will this be enough to stave off major market volatility at the end of this calendar year? Only 3 weeks to find out. Will this additional not QE4 blow the Fed's balance sheet above the all-time high of $4.5 trillion on its way to an eventual doubling next decade? Come back 10 years from now and find out. Seriously though, remember, it was only this past Christmas Eve last year in 2018 when the U.S. stock market had rolled over nearly 20%, and the U.S. Treasury Secretary Steve Mnuchin, while vacationing in Mexico, announced on Twitter that he had spoken to the U.S. heads of the 6 mega banks, the same 6 investment mega banks who we already mentioned by name, ones who own about half of the U.S. banking industry's assets today. In that late 2018 tweet, the U.S. Treasury Secretary also mentioned his key, then upcoming phone call with the President's Working Group on Financial Markets, or more aptly put, the Plunge Protection Team, as some quaintly refer to it. You can again reread what information that tweet contained from last year, but for myself, this remains the FinTwit tweet of the 2010 decade. It tells you how precarious this supposedly best economy ever remains. As we again reach new nominal highs in the S&P 500, you can choose to bet on these people having your back in best interest if you'd like. I and many of our clients will prudently continue hedging our long-term savings with physical precious metal bullion products as we look forward to the new year and a new decade to come. That's all for this week. Thank you for tuning in. And if you liked it, be sure to like the video. And if you haven't subscribed to our channel, do that. And also hit the alert button so you don't miss these market updates as they come along. Give me a comment below. Let us know what you think and what you'd like to see more of. Have a great weekend, everyone. Thanks for tuning in.